Welcome everybody. Today's speaker in the New Ideas in Insurance series is, as you can see from the screen, Alon Rubinstein. He's a recent PhD graduate in economics from UC Berkeley, and he is currently a postdoc at the Wharton School at UPenn in their Business Economics and Public Policy Department. As we'll see shortly, his work uses the tools of insurance economics and industrial organization, which is the branch of economics that deals with industry structure and strategic behavior, to shed empirical light on how insurance markets work. Spoiler alert, they don't work the way that mainstream economics seems to indicate that they should. Without further ado, I'm going to turn it over to him. We'll do the usual, take as long as you want. If you have questions, you can chat them to me. Before I do that, though, I just want to add one more thing, which is that in 2 weeks, we're going to hear from another young scholar, Mallory Hope, who will be talking about a completely different topic, namely the role of insurance in the transatlantic slave trade. So that will be very interesting as well. And Alon, the floor is yours. Thank you so much for coming.
Yeah, thank you. It's a pleasure being here, and I would love to hear your comments and suggestions on this project. I should say, I know I talked with Peter before. Some of you are usually ask your questions at the end of a talk. I would love if you could just jump in and ask anything, any questions that you have. If something is unclear or if you have any comments, I really would appreciate it. This project is called Behavior Professionals. It's evidence from the commercial auto insurance industry. So as you know, in economics, the industrial organization discipline has placed significant emphasis on selection markets, and in particular on private markets for insurance. You know, this is just a subtext list of all the papers. This could have been 3 slides long, examining the importance of private information and selection to insurance and how that interacts with welfare and with competition or different policies. But if I would say, what is the general theme of the IO field regarding insurance, is that we should always see insurance offered, unless either there's some regulation regarding price, for instance, price caps or interest rate caps that limit the firm from charging the price they wish, or that selection on private information is too severe, that when I increase the premiums, I only stay with the customers that cost much more than that price. This could have been found as a very extreme scenario, right? The idea that we'll see a complete market raveling and people who wish to buy insurance cannot, since they have private information. However, rejections of coverage is quite frequent. We see that firms tend to deny coverage, and mainly, I will say, to high-risk individuals. We see, for instance, before the ACA on non-group health insurance, that 1 in 7 applications to one of the largest 4 companies was rejected. When it comes to traditional long-term care insurance, we see data from now that 47% of individuals between the ages of 70 to 75 are declined. When it comes to credit cards, in 2020, 24% were denied, and almost half of them were below low income levels, which raises the questions of why we see such a large denial of customers. And in a general form, how do private insurance companies decide to customize premiums and coverage? And to relate to the previous slide, why do they decide to deny coverage rather than just increasing premiums? This could be a result of 3 different aspects. As we said before, it could be a traditional reason of adverse selection, putting aside for a second regulation. Another aspect could be that there's some misassessment of risk, that for some reason they think the customer will cost much more than what it's expected to be, and as a consequence, they deny the customer. And the third is what I will call, in a general phrase, adjustment costs. So adjustment costs have been a subject studied in the past in macroeconomics on why we see relatively fixed prices in the market, that there is some, what economists refer to as a menu cost, the idea that you need, for instance, in this aspect, meet again with the client and change premiums. It could be that there is some incentive to just premiums fixed instead of additional interaction with a customer. But I will also point out some idea of variable costs. This could capture, the way you can think about it is, for instance, reputation. Suppose you are a customer that had an accident and suddenly I decide to double your premium. Maybe it will give me a bad reputation, that will affect not necessarily the interaction with that particular customer, but in general thing with other customers. Yeah, Tom, I see that you raised your hand. I think you're on mute.
So what about regulators as an explanation? Like, in other words, that the carriers aren't allowed to charge a high enough price for the high-risk people.
100%. That definitely could be a reason. And I think what will be interesting in this paper is that the setting I study has no regulation at all.
Okay.
Yeah, so firms can charge any price, any coverage. They are limited, I should say, by what they can ask of a customer. So maybe they cannot ask the race or things like that, although it could be indicative based on their address and so forth. But yeah, so they're limited by what they can ask, but they can charge and deny without any constraints. Yeah, Peter.
Can I just ask, in terms of reputation, though, the alternative is to turn them down. Is that worse or better for their reputation than raising someone's premiums? Like, oh, I had an accident, they canceled my insurance, so now I have better things to say about them than if they just doubled my premiums?
That is definitely a good point, and something that needs to be obviously studied empirically. I could say that I can think on that to go both sides. Obviously, first of all, being denied could be, in some sense, being catastrophic, especially when you think about insurance. I have a bit of reputation for denying customers. It's hard for me to give you an intuitive reason why one will be worse than the other. Personally, I have the impression that, charging higher prices after an accident perhaps might be seen in terms of reputation worse. But yeah, this is definitely an empirical question, right? I don't have a clear intuition why I would go one way or the other. But definitely could be an explanation for what we see here. And my idea is I'm going to develop an econometric approach to study and identify the three components. What I'm going to do is, obviously, and this is related to the question earlier, what I'm going to do is I'm going to use data from one of the largest Israeli commercial auto insurance, which is an affiliate of an international insurance company. I'll talk about the interaction in a bit. That could be interesting by itself for a different project. I'm going to use this interaction to estimate the relevancy of these two, I'll say, channels that have been given less attention in terms of economic perspective, misassessment of risk and adjustment cost, and evaluate its consequences on the firm's profits and welfare. So in terms of data, I'm going to collect data from one of the largest commercial auto insurance companies in Israel, an affiliate of an international insurance company. This will include, if I may say, I think pretty cool data. So this is a proprietary microdata that includes all of the information available to the insurer from 2013 to 2020. So in terms of at least spreadsheets and data on the computer, there's going to be symmetric view by me and the insurer. They don't have any informational advantage on me. So I can really see what they see and how they make their decisions. And what's additional aspect that they have, which most economic papers on insurance, I'll say all of them, if I may say, don't have, is I also have data on the insurance assessment of policies before renewal. So I have also internal grading documents, which they refer to on go, no-go grades, and how to continue the interaction at the end of a contract. Do we want to renew the policy with a customer at the same price? Do we want to increase premiums, or do we want to deny the customer? Was there a question here? No, right? Okay. And I'm going to take advantage of these dates and the fact that I see all the data that evaluates each policy before it expires and recommends whether to keep premiums and coverage unchanged, adjust deductibles or premiums, or deny, to separately identify both channels, the insurer's subjective risk assessment and the adjustment cost. And let me jump to the main findings. So one of the interesting things that I find is that there's too little adjustment in terms of intrinsic margin. So when I look at prices, premiums, they barely change with expected costs as we would have predicted on predetermined factors such as vehicle age and claim history. So as a vehicle gets older, or as the customer has more accidents, we actually see that over time prices do not change as much. But which is, I would guess, one would say a positive result. But I think the con of it is that there's too much adjustment in the extensive margin. What do I mean by that? So there's not a lot of changes on the price, but there's a lot of changes regarding the decision whether we want to keep interacting with this customer or not. And we see extensive denial of insurance following a negative outcome. And I would say, especially for small clients. I'm going to talk about that in a minute, but the way you need to think about it is, I'm thinking about commercial auto insurance, is that each customer is a business, right? So we're going to have, for instance, one of their customers is one of the largest bus companies in Israel, one of the largest grocery stores. And on the other hand, they also have customers such as, I'll say farmers, right? Self-employed individuals getting their produce to the market. Or we even have some minibus taxi cab riders, right? So we have a lot of heterogeneity in the customers' characteristics that are getting the insurance. And we're going to see that the ones that are relatively small, that only own single vehicles, are the ones that are mainly harmed by this behavior. In terms of risk, I find that although prices do not change as much, the firm is actually pretty aware of a pattern. So it doesn't look like they have a substantial misassessment of risk. Obviously, the coefficients are not going to be 1-to-1, but we're going to see a very similar picture. The only thing that I can point out as it looks like a misassessment of risk is that they overweight recent claims. So when looking at the aggregate claim history of the customer, it looks like they are giving too much attribute to the last year performance. This is obviously seems very weird when we think about machine learning and algorithms. I'll show you a figure at the end of the talk, which suggests that they use the same algorithm for all types of customers. So they have, I guess, a pretty sophisticated algorithm, but they use that for both the small customers and the large ones. Which in general, when thinking about other products could be okay, but when thinking about insurance and specifically that the claim history, when it's based on 1 year or 10 years of information, has very different information that it carries, is not the right way to go. Effectively, they're using one algorithm for the small and large customers. The large customers enjoy it, the small customers are harmed by it. In terms of what we call an adjustment cost, so I see there, which I guess relates to Peter's questions, that it looks like they are increasing with realized profits and price increase. Let me say it in a very simplistic way. It looks like they behave as if they have a good deal. If a current client is paying more than what it's expected to pay, they'll just continue on. They will not try to extract more profits. They see it as a good terms, and they'll just continue on to the next year. And on the other hand, if they see that they perceive that a substantial increase in premium is necessary, they'll just deny the customer. So it looks like there's a very small margin where, prices you could increase by 10% and making that customer from a bad one to a good one, and they will wish to do that. But if it's larger than that, they'll just deny the customer. And on the other hand, if a customer is, very profitable, they will not try to extract more profits. They'll just continue on. And both of this channel lead to the flat pricing and excessive denial, which keeps prices unchanged. And I guess customers enjoy it with regards to new vehicles and good performance, but they tend to deny quite substantially coverage to all vehicles with bad performance. And while showing the last graph of this talk, that this misassessment of risk and necessity to adjust is diluted by the client's fleet size. So sorry about that. So for instance, if you have a fleet size of 5, suppose you own 5 vehicles and you insure them, you're not very much affected by this frictions in behavior relative to what we expected to see in the traditional economic framework. However, when we're looking at a single vehicle customer, that client will be very affected by this behavior and could be excessively denied coverage after a claim.
Tom, I see you have your hand up.
Yeah.
Sorry.
So I have 2 questions.
Mhm.
One is there something about a customer with with just 1 car or 2 cars that makes them a kind of different customer so that it's rational to have sort of essentially, even though using the same algorithm, but an algorithm that it treats the little guy better than worse than the big guy? And then secondly, I'm just curious to know, like, what did these guys think when you gave them this information? Like, what did they say? Like,
So you're asking what? So let me refer already to the latter question, I guess. So actually, what I'm going to show you is that they were interested in the way they were pricing. I guess this is true for a lot of companies in this market. They focus a lot on assessing risk, but not too much on how much we can extract from the customers. I actually showed them the result. I was shocked by the patterns, and I saw in the data. And you'll see in a graph, it looks like they change their behavior a bit, but not as much as I guess the economic principles, estimation process would have expected to see, right? So you're going to see.
I hope
that
they gave you a
change a bit.
bonus.
So I was unpaid free labor for them, yeah, but I got this data, so and the cadets might be more beneficial than what they would have paid. I don't know,
exactly.
yeah. So, and remind me of the first question. Oh, regarding 2 customers. So the way I think you need to think about it is this: suppose you see a customer that had 2 customers that had a bad outcome last year. One of them has only 1 vehicle, and the other has 100 vehicles. Now we understand that insurance, that it's not only the actual risk. There's a lot of I'll say random shocks in the behavior, right? You can be a good driver and have an accident, and you can be a bad one and not have an accident. So when thinking about looking at the same outcome for an individual that had only 1 vehicle versus 100, you should always think that if you see a bad outcome for an individual that owns 100 vehicles, kind of 100 random samples, or in that perspective, you should think that this client is really bad, right? And when thinking about a customer that only owns 1 vehicle, it could be that the randomness is obviously much more important. And we should not try to anticipate and extract too much knowledge from that outcome. When you use the same algorithm for both, you're going to overweigh the importance of information when you don't have a large sample size. And that's exactly the reason that they're going to arm the small customers. Is
that like in econometrics terms? Sorry, that's like an empirical Bayes kind of thing where you have a better precision of your estimate for the large than the small, and you need to take that into account. That's the issue.
That's exactly right. That's 100% what we saw here. That it looks like they don't take into account what's known as the signal to noise ratio, right? The importance of the signal.
Do you think they're being affected by the fact that if you don't renew this big customer, you're going to lose more premium? In other words, it's almost like 2 different, that's not rational, but it's like, oh, if I don't renew this customer, I'm going to need to fill that hole somehow, and that's going to be hard to fill. Whereas if I don't renew the single customer, I just need one more customer.
That could definitely be the case, especially in this. I will not talk about it a lot, but there is some agency issues in here in the sense that I'm sure they benefit the revenue more than what they should have benefited profit. In that sense, just like we think about salespeople and so forth, that they get bonuses for revenue. But so if I would have seen that result, I would have agreed, but it's unclear to me why that should affect a small profitable client, correct? So if I would have seen not enough decline rejection, I would have said exactly that. It could be that there's some additional benefit with continuing the interaction with a customer that is unrelated to premium, and perhaps much more so for the large customer. But it's surprising, especially the magnitude of denial for the small customers. Basically, that cannot be justified, right? And I'll show you that when I say benefits from large customer, even a fleet size of 4 vehicles is enough to produce a substantial benefit. It doesn't have to be kind of a 100 vehicle fleet, which, by the way, in a different aspect, one could ask, why would a company with 100 vehicles even buy insurance, right? But not going to get into that in this talk. But yeah, that's a very good point, and one that should be taken into account. Exactly.
Trev?
Yeah.
Just to jump in on something you said in response to Tom's and Peter's question. So on the not considering signal to noise ratio, I mean, you can imagine a hypothesis whereby the insurer is worried about moral hazard, like a small policyholder that knows that the insurer, like if the insurer did take into consideration the signal to noise ratio, you could say, look, I just had a bad day. It was a random risk, like give me a break, don't raise my premiums. And it's that concern that motivates the insurer's tendency to just non-renew small policyholders with like a recent bad outcome. Does that make sense?
So I would have said it a bit. So I guess in the spirit of what you say, one can think that, the idea that the customer is penalized by being denied insurance after a claim would result in the customer being overcautious when driving. I guess this could be true for 100 vehicles, but also for one as well. And that could be a point well taken. What you're going to see, I'm not going to show it in today's talk, but what you can see is that when thinking about insurance, they have 2 dimensions. So they have a premium, but they also have deductibles, right? So one has to wonder, why do you deny the customer and not try to increase deductibles as they do? And what you're going to observe is that they don't do that enough. So they almost don't play at all on the deductible margin, which I was shocked by it, right? Why not just increase the deductible after an accident instead of denying the customer? It looks like they behave as if I guess the way to say it is that they think of a world as good and bad customers. And once they think you're a bad one, they don't want any business with you, right? They're not trying to fix you and kind of convert you from a bad to good customer. They'll just stop the interaction with you. But I definitely see that for large customers, they're willing to pay a higher price in order to convert them from that bad to good customer. So that is definitely the case, which I guess was related to a bit to what Tom asked before. Yeah. Let me just very quickly talk about the literature. So there's been work, obviously, on imperfect competition. And obviously, market power is very important when analyzing selection markets. I think one thing that people did not point out before is that market power also allows firms to deviate from conventional behavior, right? And as a consequence, we can see a lot of things that we do not expect to see, and that could have a quite dramatic outcome in terms of profits and welfare. In terms of pricing, so there's been some work on uniform pricing, with the idea that firms charge the same price for the same product across markets, or for instance, charging within a market on different movie, the same ticket price. Here, I think, is very interesting when thinking about an insurance, in the sense that that flat pricing, the necessity to not change prices across different dimensions of a customer, could result in the customer being denied, right? And as a result, could cause a lot of harm actually to our customers. And this is obviously related to the way we think about reclassification risk or market unraveling, but the idea that the premium could change a lot after an accident, or you'll even be denied. And I'll show you that there are frictions in behavior relative to the conventional, rational economic agent exacerbate that. This also is related, I should say, to group insurance, right? we usually think, how do we compare insurance between one individual to, or for instance, employee-sponsored insurance relative to an individual buying insurance? There's been talk about, the benefit of of group insurance, in terms of bargaining power or risk pooling. I'm going to show you that even when you're putting those aspects on the side, those frictions dilute with the customer's size, and as a result, generate kind of, on the demand side, kind of increasing return to scale, kind of an additional benefit to group together when buying insurance. And this is also related, obviously, this work to inattentive. I'll show you a bit of evidence of inattentive customers and kind of demand aspects that are behavioral fractions in the demand market as well. And I'm going to show you a bit about managerial practices, how they change their pricing when they basically see the results in this paper. So I'm going to talk very quickly about the setting, reduced form evidence, and very kind of just jump to the main results in terms of the structural estimation. So let me talk about very quickly about the settings. So as I said, this is micro data from 2013 to 2020. This is large commercial auto insurance, includes trucks, buses, heavy equipment, and a few more stuff. And as I said, this is a very heterogeneous portfolio. So you have 10% of the firm's portfolio is single fleet vehicles. A quarter is what they call non-fleet. So if a customer has below 5 vehicles. On the other hand, 30% of the portfolio is fleets larger than 100, right? So this is a very heterogeneous portfolio in terms of the insurer. And we see, I'll show you, it doesn't adjust enough to the heterogeneity in it. This is an affiliate of a multinational insurance company. I'll talk about the interaction between the two in a second. Their assets of 2021 were $50 billion. So you should think about it as a big insurance company in Israel interacting with a multinational, huge insurance company, and not some small insurer making some mistake. This market, I think this is related to the question earlier, this is completely unregulated. They can charge any price, and any coverage could be denied. I should say, though, liability insurance in the Israeli market is basically offered through a different market, heavily regulated. You should basically think about it as something close to government-sponsored insurance. So this insurance will be mainly on comprehensive and third-party coverages. So as I said, that I have all of the data available to the insurer. This includes contract and outcome characteristics, vehicle characteristics, client characteristics, and also data on the pre-renewal policy assessment known as the go, no-go grades. Let me show you very quickly the supply chain and the demand side here. So the relationship between the multinational insurance company and the Israeli auto insurers is that they provide capacity. As a result, the Israeli auto insurer charges some price and gets a share of it. This is, I think, related to Tom's comment earlier. They only get a share of it, and the rest is given to the multinational insurance company. In terms of cost, the multinational insurance company will pay all of the damages, and the Israeli one will be basically covering all of the expenses within this local market. So it definitely could be that the interaction between the two could lead to the consequence that the firm, the Israeli insurer, will want to keep more clients than what it should have. I'm going to show you that that's not a worry, but definitely could be in some settings. In general, I'll say that in this paper, I'm going to analyze kind of a union of these two without taking into account too much on the relative share of each one in the pie. And as I said, liability is not covered, but there is coverage of third-party property damage, own party coverage, and comprehensive, which also offers theft insurance. Let me show you a bit of a summary statistics, just to give you a few puzzling already results in here. You can see that in general, when looking at the entire sample, which what you see here on the left column, premiums relative to the other groups, which is vehicles that are age 6 or above, or the last columns is customers that had at least one accident in the previous period. You can see when looking at the premium per value, which is the last row, which is the way prices are offered in this coverage, that there is some variation. They do charge more. They anticipate them to cost more, but not a very substantial variation in terms of prices relative to the cost. You see that in terms of the mean damage, the average damage for each one of these groups, you see very different results. And as a consequence, when you look at trucks, the profit margin is 16%. I tried to ask them whether they're satisfactory with this result. The way they described it is that above 20% is fantastic, and they're happy when it's above 10, just to get your perspective of how high or low is a profit margin. But what's very interesting to see here is that looking at trucks with vehicle age above 6 and vehicles that had an accident the previous period, they're on average losing on those policies. Definitely not to take from here that this implies that there's a systematic mistake. I'm not going to show you in this talk, but there's a lot of cross subsidy between the fleet. Obviously, if there's a customer with an old vehicle, but a lot of young ones, the prices will be more beneficial relative to an individual that has only old vehicles, right? But you already see these summary results, statistics that show that it looks like premiums are not adjusted enough for these two problematic quote unquote groups. And before jumping on more to the results, I want to explain a bit about the kind of the renewal process. So we start at stage one. This is the operational or the analytical team provides the COO with recommendation how to continue. This will be given as in terms of grades. They will be called go and no-go grades. I'll give you an example of how it looks in a second. The CEO provides kind of goes, I guess, gives a look at those grades. Sometimes could be the case that they change those grades, although that doesn't happen much. And they provide the underwriters the recommendation of those grades and how to continue. In stage 3, there is a bargaining between the underwriter and the customer regarding the how to continue on after the policy ends. And the underwriter in stage 4 goes back to the COO for approval. Usually this is just a formality. Could be sometimes that the customer really wants to change something substantial, and then the interaction is a bit more important. Let me give you an example of a go, no-go grade policies. So this is in Hebrew. I'm sorry about that. I translated the most. So this goes from right to left. So you have here the policy number, the beginning date of a policy, the end date. So you can see here all the policies are ending at the end of February. And here you have a go, no-go grade. So an example for go grades will be either just a check. They will note charge the same as last year or do not decrease premiums. In terms of a no-go grade, I gave you here, for example, it could be increase third-party deductibles, for instance, by 7,000 to 7,000 shekels, or perhaps increase premiums by 7.5%, or maybe just offer third-party property coverage and not comprehensive. And lastly, you can see an example that due to claims did not renew policy. So it could be either one of those four. And I think what's very interesting already to see in the summary statistic you have before, and this is true, I guess, for car insurance in general, 87% of policies will receive a go grade, right? We're thinking about car accidents. Most customers, even if they're bad ones, don't have an accident, and they'll just continue on to the next year with the same terms. But what's, I think, very interesting to see is look at the proportion of policies that are given an adjustment or denial. And what you can see from here is that over 40%, right, 5.6% of the total policies are being denied, while among the share that are not given a go grade, only 60% are requiring adjustment. Already gives you an intuition that looks like the extensive margin, the idea of just denying coverage or denying comprehensive coverage is much more important than rather, increasing premiums after an accident, which already gives you an intuition of what I'm going to show you in the paper. Let me go to a few findings that we're going to have here. What you're going to see in this graph is I'm going to focus on non-fleet vehicles, clients, those with a limited number of vehicles. And I'm going to run what's known as a fixed effect regression. So I'm going to look at the same license, the same vehicle over time as they age. What you can see on the x-axis is the vehicle age going, from 0 from a new vehicle to 10. And on the y-axis, you see in blue the premium per value and the cost per value. And what's very interesting that you can see from here almost immediately is that the premium per value for the same license, the same vehicle, doesn't change much over the vehicle life cycle, but it looks like the cost per value increases substantially, right? Just to get a perspective, it increases by a magnitude of almost a factor of 7 relative to the slope of a premium per value, already suggesting that there is not a lot of adjustment in the premium per value, but I should say this is conditional on allowing the customer to renew the policy, right? So all of the graphs here is based on individuals that were offered insurers the possibility to renew coverage and decided to do so, and does not take into account customers that were denied. But what we're seeing already from here, that looks like once the customer renews, premiums are very flat per value terms, while the cost is not.
Can you just say something quick about whether there's a lot of turnover, voluntary turnover, when the customer gets their new premium? Do they then say, I'm leaving, or is that relatively rare?
Yeah, no, so it definitely is common. I will say more so for the small customers. I think the way you need to think about it is that for the large ones, if the customer is not happy, they will just renegotiate until they find, the winning premium, right? That makes everybody satisfactory. When it comes to small customers, you definitely see some of them leaving. A lot of them also leave for reasons unrelated to price. I should point that out. The service after an accident was not optimal. There was a problem getting the money after a claim, or, the company took a while until they did it, or for some reason that, a lot of reasons that customers, choose new companies for their services. But yeah, definitely price is one of them. Actually, I'm not going to show you here, but one of the results that's interesting is that it looks like customers do not tend not to change their insurer if premiums do not change. So this is kind of related to the literature on, I'll say, rational inattention. If prices stay the same, it doesn't look like the consumer is thinking about whether I need to search again for a new premium, for a new policy with a competitor. It looks like most changes occur after an increase in premiums. Yeah, and customers are very sensitive to that. So yeah, this could be also taken from here, but it could be that it's the optimal strategy in terms of a customer behavior, not to change prices, because if taking to the extreme, if they are super sensitive and they leave after an increase, maybe I should just stick with the same premium. Yeah, that could definitely be the case. Now I'm going to show you results by looking at different vehicles, different policies, taking into account their characteristics, and seeing the next year result based on whether the vehicle had a claim in the current period or not. And what you can see is that claim history is very predictive, not surprisingly. What you get from here is that customers that had an accident in the previous period are much higher probability to have an accident in the current period, which is not surprising. In terms of, let's quantify it in terms of damage per value, since I showed you premium per value, they cost in terms of per value terms, almost 2.5% more relative to customers that don't have an increase, that didn't have an accident in the previous period. By how much does the premium change? By only 1.7 percentage point, I should say. So it doesn't look like premiums change as much as the damage per value indicates after a claim. And as a result, what you see here is the loss ratio, kind of a ratio of damage to premium, is much higher for policies that had a claim in the previous period. This is huge. This is 54.7% higher loss ratio. This is big difference between those kinds of customers. So all of the results here suggest that premiums do not change enough with expected cost as projected by vehicle age and claim history. It could be a lot of explanations. Let me show you two of them. The unusual pricing by one firm. It could be that the entire market is perfect. This firm that I'm interacting with, this insurer doesn't know what he's doing, and one day it will be crowded out of the market since it's not profitable. And also, other firm reacts to the results. There's fascinating patterns regarding pricing. So obviously, there could be a concern that just data from one insurance company. And in order to kind of examine how the market behaves, I'm going to collect data from the competitor. I'm going to do so by generating fictitious policy application through an Israeli insurance agency. So this, unlike before, this is now going to be policies only for a new quote-unquote policy. So it could be the case that different insurers react different to information over time. But I think from analyzing, the first price for a new policy, we can learn a lot about whether this insurer behaves similar to the other ones in the market. So I took more than 1,200 pairs of truck model value year, and I've created a few observations for both. And let me show you the results. So, I should say you have a picture here. I kind of plugged in all the information using a bot, right? All the start date, end date, and so forth. And different insurers gave me different prices, which I collected. Here you have an example of free offers by different insurers. And I'm going to show you now the market premium. So what you see here, this looks very similar to the previous graph I showed you in terms of premium per value. And that is, I guess, satisfactory because this is not data given me by the insurer. This is data that I collected from an insurer agency. And you can see that the slope of a graph of a premium per value almost looks similar to what I showed you before. Now I'm going to show you the other three main competitors. So you can see rival 1 and 2, very similar prices, right? It looks almost like they're on basically charged the same. And rival 3, you can see that it looks like it's much more sophisticated in the sense that it understands that it needs to charge a higher premium when the vehicle is older. So remember, rival 3 is the more sophisticated one, and I'll show you a very interesting slide in 2 more slides. First of all, I'll show you one of the worries here. I should have said it could be that the insurer rival 1 and rival 2 are colluding, right? So it could be that they're not doing the profit maximizing behavior when taking only themselves into account, but there's a collusion between all the market participants, and for some reason, this particular premium is the equilibrium one. But you can see that although their trends over the vehicle age are similar, what you see here is the premiums they charge, normalizing one will be the lowest among those 3. So you can see that it doesn't look like prices are identical, to say the least, right? It looks like the premiums vary much across different customers. But when it comes to vehicle age, the trends are similar. Okay, so I showed you before, the behavior with regards to vehicle age. What about claim history? So what's very interesting here is that it looks like I showed you before, right? That once you have an accident, they charge you a bit more, but not enough. It looks like rival 1 and 2 don't even increase the premiums on average, which is almost remarkable. So whether you had an accident, one accident or none in the last 2 years, they're going to charge you exactly the same price. What about the more sophisticated one, rival 3? Notice that I don't have a result for that. And the reason is that they don't offer coverage. They're not willing to take new customers that had an accident in the last 3 years. They will just deny, which is almost remarkable and kind of gives you kind of a very, on one hand, good view that this firm is sophisticated. But on the other hand, it looks like that also they don't want to take new customers, showing that the idea of denial is not necessarily related to the fact that the company is not sophisticated enough. And by the way, throughout this market, which is almost amazing, if you had more than 2 claims in the last 3 years for that vehicle, you'll not be able to be offered insurance. I should say this rule is true for single vehicle insurance, single vehicle policies. When talking about fleets, this is obviously not the case, but you do see this behavior of substantial denial for a company that only has 1 truck or 1 bus. So definitely shows you that the amount of rejection in this market and the inability to buy comprehensive insurance is substantial. Okay, let me jump already to the last graph here, which I think is interesting. So one of the questions was, why did they give me the data, right? And what they learned from it. So what I'm going to show you is I showed them exactly the same graphs I showed you so far. And I wanted to see how they change their behavior as a result. And what you see here in red and orange is the pricing scheme 2 years and 1 year before I gave them the information in terms of premium per value and different age groups. And you can see it looks like they behaved the same. What you can see, the blue curve is the premium per value over different age groups after showing them those results. Why is that important? This already results suggest that in some sense, there is some, I'll say, lack of information regarding the client's behavior. What do I mean by that? Suppose they knew, right, this information, the one that I presented them, then it's just showing them the data of something they know should not cause them to change their behavior at all, right? They already know that. I showed them the results. They're not going to change anything. The fact that I do see some change in the pricing scheme suggests that they did not take those patterns into account, which is remarkable when thinking about an insurance company, right? Where the job is to analyze information. But one more thing that I should say on that is that they change, you can see it looks like the pricing slope is much steeper, but when looking at that relative to the cost per value that I showed you before, it's not steep enough. In some sense, just to get an emphasis, it looks like that relative to the steepness of a cost per value with regards to different age group, they only increased it by the price curve by 20% factor relative to what they should. Yeah, Peter.
Maybe this is not a fair question, but like if you could play ethnographer for a second, when you're talking to them, literally who are you talking to? Are there economists there? Are these actuaries? Are these just insurance business people? And how sophisticated would you say that they are? I mean, if you, this seems incredibly convincing, but maybe they're just not into that or something. Like who are these people that you're conveying this information to?
Yeah, that's a great question. And I want to make clear, I'll show you in a few slides, a few more results. They are aware, and this is, I think, what's very remarkable and already suggests the importance of using firm data, is that when I take into account the go, no-go grading and assess their perceived cost, they understand that vehicle age implies higher costs. It's just that they don't take into account that in their pricing screen. So the way you need to think about what you see here is that prices are now higher because on the one hand, they decided to increase premiums for a few good customers with an older vehicle. But on the other hand, there's more customers that before were denied. And now they understand that it's perhaps a good idea to charge a higher premium relative to denying them. The one that I talked to, just to get a perspective, will be both in the Israeli insurance company will be the CEO, the COO, the head of the analytical team. And, you know, this results kind of, first glance will look like the analytical team, one can think, doesn't know how to assess risk. But the result will be, which I think is very important, they assess risk pretty well, putting into account the idea of signal to noise ratio. but that is not reflected in the premiums. There's kind of, but when you think about it, there's kind of a, putting aside what the analytical team does in terms of assessing risk, there's kind of, I'll call CEOs or all the other quote unquote policymakers that give a policy regarding how we should take the risk and adjust that in the premiums. And it looks like they don't do that enough. And I guess a perspective that you can think that in their eyes, you know, we just, I guess this behavior could suggest that their behavior is closer to one that's not, I guess, the economic rational agent maximizing profit, but rather saying, you know, we want to assess if this customer is profitable. If we think that it is a profitable customer, we continue on with the interaction. And if it's not, we're going to deny him. And when this is the rule of thumb, you can have these patterns of pricing scheme, although they are completely rational regarding how costs behave. So this result for no way means that they don't know how the cost changes. I think they were shocked, and I think this is related to what you asked. I think they have a lot of knowledge regarding cost. They don't have a lot of analytical team checking the pricing scheme. Or to put it differently, it doesn't look like they put a lot of effort in assessing the demand curve, but rather they have a lot of actuaries that analyze the cost. Yeah, Tom.
So a controversial practice in US insurance pricing is, I'm blanking on the name of it, but it's basically where you charge customers, you take into account their likelihood of switching. And so that
Is that price optimization?
price optimization, right? Is there, I mean, this is totally orthogonal to your question, but it's, you know, is price do they think about price optimization? Because, you know, that's a sort of, you know, you could think about it as sophisticated, or you can think about it as evil, or you can think about it as both approach to pricing that, you know.
Yes, what I'm going to show
also like totally inconsistent with what you're observing.
So I'm going to show you in the structural part, which I'll get in a second. I basically do the price optimization and examine what they should have charged. And one aspect which I think they get correctly is that customers are very sensitive to price increases, right? So most of them are basically, you should think about it as sleepy customers, you know, nothing changes, they'll just renew the policy. And they're very sensitive to the fact that prices change. And as a consequence, you know, the rule of thumb of not changing premiums is perhaps quite sophisticated. And although it's just a rule of thumb, not very far from reality, but it looks like what they're doing is basically overreacting on that rule of thumb, especially for customers that are denied. They have a tendency to deny too many customers. But yeah, I think this result is definitely, and you'll see in a second, reflects not the actuaries making mistakes, but rather that the price optimization is far from being optimal, for sure. Okay, let me jump to the structural estimation, and I'm going to show it. You know, there'll be graphs, but let me explain what I'm going to do. So when you look at the distribution of go and no-go grades, I'm showing you now the grades regarding individuals that I see increasing premium. So the increase will be 2%, 5%, 7.5%, 10%, or 15%. And I'm going to use that discreteness in terms of the amount they want to increase to estimate their perceived cost and adjustment cost. And the idea, not talking too much about this, is what we call using the economic discrete choice model, which basically says, look for each group based on their observable characteristics, how much they basically are divided across groups, whether the ones that receive a go grade, one that are denied, one that have a increase by a small premium or substantial increase by premium, and using the differentiation across these groups by observable characteristics, we can quantify, I'll call it the firm's utility, quote unquote, from each one of those scenarios. By normalizing the denial to zero, or to put it differently, by constraining that if the firm has zero profits when they reject the customer, you could calculate or estimate, I should say, the profit under each one of the other three scenarios. Now, when thinking about the grade go, when premiums do not change, that implies that revenue, right, does not change. And if I know the profit and I know the revenue, I can extract the cost. And that's exactly what I'm going to do here. So it's very easy to identify with this sort of data the expected damage, the perceived one by the insurers. What is more difficult is differentiating between the perceived demand and adjustment cost. Or to put it differently, it could be that the customer is denied because the adjustment costs to increasing premiums are very high, or it could be that the insurer has a misperception regarding demand and believe that the customer is much more sensitive to a price increase relative than what they truly are. Obviously, I'm not able, it is impossible to separately identify between the two. So what I'm going to do is I'm going to estimate kind of in a different platform all of the demand of the customers, and all of the adjustment costs are relative to the idea that the insurer perceives correctly demand. So it could be that the high adjustment costs that I'll show in a second actually reflect the insurer's misperception of demand. They think that customers are much more sensitive to price increases than what they truly are. And let me show you a bit of the results. So what do I mean by, so I should say a potential threat in terms of identification here using the econometric tools is soft information. The worry here is that the insurer has more data than me, right? Basically, the only way to solve and really to assess the perceived cost is by assuming that me and the insurer, when we look at the data on the computer, we see the same data. It could be, for instance, when thinking about large customers that, okay, I'll get in a second, Peter. It could be the case that this is not the case, right? For instance, you have large customers that bargain and interact on a weekly basis with the firm, and as a result, the firm knows more. So I want to focus on the small customers. And I'm going to allow adjustment costs to change by the aggregate profits throughout the interaction with the customer, the previous year profits, and the price increase that is needed. And here you can see the results. So what you can see here, I already translate that to you in economic terms. Increasing premiums by 1% is equivalent to increasing the adjustment cost by 5%, right? So definitely looks like it's more costly. The adjustment cost is more costly as the required increase in premiums is higher. On the other hand, when looking at profits, obviously you can see that when the customer had a good outcome in the previous year, the adjustment costs are huge. They're not going to try to increase premiums on a good customer. That's what you can learn from here. But they focus only on the previous year result and not on the aggregate. In terms of demand, obviously I would have want to talk about this more, but I'll say here very quickly that I'm basically using the standard approach to estimate demand as done by the standard IO literature. And there's nothing new on that. And what I'm going to show you here is a comparison between the perceived cost by the insurer and the actual cost. And what you can see, let me jump to one of the results here. What you can see from this result when looking on the right column is you can see that obviously the aggregate loss ratio of a customer is important, but from the blue column, you can see that the sum of them is close to zero, which implies that if you don't have a lot of history on the customer, it's not that valuable to look at it. The coefficient of importance changed from 0.09 to 0.7. So obviously that signal increases a lot in its precision over over the sample of a customer history. While when looking at the perceived cost, it doesn't look like it changes by much. Another way to see it is you can see the previous year loss ratio, the previous year outcome, do not have any additional information when assessing the cost relative to looking at the entire aggregate performance throughout the client's history. while it looks like the insurer gives it a lot of importance when assessing whether to continue with a customer or not. You can see vehicle age, it even looks like, although I showed you the premiums are flat, it looks like they even are a bit too harsh on the customers in assessing the cost of old vehicles, which is kind of the opposite of what I showed you before. What about demand, kind of in order to understand the price optimization? So customers are very sensitive to the premium, but they're also very sensitive to the fact that they see a price increase. A price increase is equivalent to a 10 or 15% increase for the average customer. So just the fact that you see an increase in premium without the actual nominal value of it is very important to the customer. Now, in terms of implication, if I compare what I see in the data to what would have been, I guess, the optimal frictionless insurer, what you can see here is a benefit and con. Let's look first on the left graph. You can see that for good customers, it will be optimal to charge a higher premium. You can see here in the lower premium per value graph. But on the other hand, we're looking here at the top of the distribution. You can see that denial is much less common when looking at the optimal frictionless insurer relative to what we see in practice. So the result here shows you, on the one hand, prices are lower than what a profit maximizer firm would want to do. They don't extract enough profits. On the other hand, we see too much denial of customers. It's kind of a trade-off between these two aspects. By the way, okay, I'll talk about that later because I see we're running out of time, if everybody wish. Now, in terms of counterfactual, why is that important? How does this behavior change the customer's perspective relative to just an frictionless insurer? So what I'm going to do, I created kind of a counterfactual. I basically created synthetic fleets by just taking the same vehicle and multiplying it by 2 and 3 and 4 and looking at that aggregate behavior and how the firm would have acted relative to seeing a fleet size of 1 relative to 2, 3, and 4. And what's very fascinating here is looking at the same vehicle, but just multiplying it by 4 results in the denial probability being much lower. That's not surprising. This is kind of the law of large numbers, right? The possibility of extreme scenarios is much lower, and as a result, denial is less common. What's very interesting here is when increasing the fleet size from 1 to 4, we see that both the utility of a customer and the profits increase, the utility by 10% and the profits by 7%. Intuitively here, which I think is very interesting, once a fleet size is larger, on the one hand, customers are not denied and prices do not change, so they benefit from it more. On the other hand, the firm has to deny less customer and make less adjustments, right? So they enjoy a higher profit. So it looks like both kind of customers, both the customers and the firm enjoy the fact that they face a higher fleet, a larger fleet size relative to a small one, which already gives you some intuition when thinking about, I guess now if ACA is less relevant, but thinking about group versus non-group insurance, could be the case that those frictions result in the fact that both the customers and the firms would prefer to interact with a large group. So just a few concluding remarks. I kind of showed you this micro data from a large commercial auto insurer to examine how firm process information, assess risks, can offer price and coverage. I find that there's a deviation from the naive optimal behavior in 2 ways. Too little adjustment in prices, especially with vehicle age and claim history, but as a consequence, too much adjustment in the extensive margin, excessive denial of customers, and this mainly harms the disadvantaged small and old vehicle customers. I'm guessing I ran too much out of time. I'm sorry about that. I guess some of you need to go, but for those who can say, I love to hear more comments from you. And thanks again for the invitation.
Oh, thank you very much. Please join me in thanking Alon. Those of you who need to be excused don't need my permission because you can just log off. But if you want to stick around.
Sorry if I took too much time. No. We should have ended at 5, yeah.
Not to worry. Yeah, so the floor is open. Anybody who's still here, people say they have to leave, so goodbye, goodbye to you who have to leave. So Alon, can I just ask, is there some, so you have the one problem is that older vehicles are not sufficiently penalized for being old. Another problem is that the vehicle, that the recent accidents are given too much weight relative to older accidents. Are those kind of examples of the same thing, or those are just happen to be, just
That-
facts about the way they operate or something? Is there some deeper theory that explains why those particular mistakes would get made?
So that's a good question. I think that we need to analyze both aspects differently. And the intuition for that is one, reflects deterministic changes. The vehicle gets older, everybody could predict that, right?
Mhm.
There's nothing new about it.
Yep.
On the other hand, we're looking at performance, and this is obviously true for insurance, but all information markets. There's some uncertainty. Every period we discover more information, right? We learn more and we are smarter. I think what's very interesting, I jumped through it very quickly, but I'll show it again here. What you actually see from here is that the firm perceives the cost of old vehicles to be actually higher than what they truly are. So how does that relate to what I showed you before? The way you need to think about it is that old vehicles have a very hard problem getting insurance. They're basically denied. The ones that stay are the ones that performed amazing throughout the periods, right? The one that for 10 years had no accident,
Mhm.
and then they're given the same price and nothing changes, right? So I think what you see here is actually the lack of adjustment in premiums when it comes to age results in the fact that when looking at old vehicles, it will be very hard for them to get insurance, and they have to perform very well. And B, usually, if after you give them the insurance, there's some predicted loss regarding their behavior, which is, when you ask about the interaction and the others about the interaction with a CEO of a company, and also it's very, I think, hard for them to grasp the idea, which intuitively is very hard to do, that if you have a customer with an old vehicle, although they did not have an accident for instance, the last 5 years, you should perhaps increase their premiums, right? It's something that's hard to grasp. Why this client was always profitable. How can I justify an increase, quote unquote, in their premiums? I think that's related a bit to the reputation. And they'll try either to deny the customer or perhaps move them to third-party coverage, which I think they perceive in terms of their business relations as easier to do than now justifying a substantial increase in their premiums. But I think regarding your question, performance is much different in the sense we should not see that. And I think the previous year, the fact that they attribute too much to previous year outcomes is definitely related to the fact that they use the same machine learning algorithms to the large customers and the small ones. And the way you need to think about it intuitively is that when you see large customers, you're not going to see a lot of variation in their performance, right? So nothing is going to change much. And as a result, if you suddenly see a change, even a small one, you need to react a lot. On the other hand, when you see small customers, you should almost expect the firms to change dramatically, right? Because it's only one vehicle. You don't have all knowledge of it. Things are going to need to vary a lot. Think about it as using, analyzing a customer when you want to rent them a place, if they have a 20-year credit score or a 2-month credit score.
Yeah.
Right? The informative of that credit score is not going to be as precise or as high. And as a consequence, what they should have done is, I guess, take the idea that the information in terms of its precision differs substantially throughout the client's history or sample size. And my intuition is that their main business focuses on medium or large customers, which, after having, even for a customer that has 6 vehicles, it doesn't look like there will be the, I'll say the extreme scenarios are as plausible. So, they could say, and I think this is a bit of what's going on here, they serve both large and small customers. Large customers are almost 85% or 80% of their portfolio. They mainly focus on that. There's not a separate market for small customers. They use the same rules. And as a result, the small customers are harmed by it.
So reluctantly, I have to say that I have a class which actually started 12 minutes ago. So they know that I'm often late, but I'm afraid I just have to go.
Oh, okay.
I would love to keep on talking to you. And so come back again when you have more results to share. Thank you so much for doing this. And
thanks again.
Okay, really appreciate it. Thanks for coming.
Thank you.
Okay, bye-bye, everybody. See you.
Bye.